Welcome to the Zawya Podcast. This is Noha Al-Hinnawi, and today I'm speaking to Ahmed Shams, Managing Director and Head of Research at EFG Hermes. Shams is sharing insights on Egypt's economic outlook after Ras El-Hikma mega investment deal, which came as a lifeline to rescue a country that was on the brink of sovereign default. Besides Egypt, we're discussing the outlook on emerging markets and the GCC region. Thank you so much for being with us today.
It's my pleasure, of course.
What's your forecast for the exchange rate of the Egyptian pound?
So we don't have a specific forecast for the Egyptian pound. We can talk about a range because there are a lot of moving parts. What I can say here is that the funding gap of Egypt has been almost covered until mid-2026, which is something very positive. So when it comes to the currency, I think the currency should continue to trade between the 45-50 range until that time, when it comes to like late 2025, mid-2026. I don't expect much fluctuations in the currency. From a funding perspective, we are covered so far. The question is what is going to happen next. But from a balance of payment perspective, there are a lot of challenges, but at least we have fully rescheduled the debt obligations that we are facing in the next couple of years.
When you say the challenge lies in what comes next, what exactly do you mean?
So there are a lot of challenges because we're living in a region where the geopolitical risks are rising. A lot of moving parts on the political, on the geopolitical, and on the economic side as well, because we are an emerging markets. The region is full of, what's happening in China will have implications on all of the regions and all the entire emerging market class. In specific, oil prices, rates, the rate cut, it's proved to be slower than expected. So on the financing side, there are also some challenges. If we're talking about Egypt in specific, I think the energy sector is being under or is seeing significant challenges because we are exporting less gas than before. So we are turning again into a deficit, which could pressure somehow our trade balance. We're not talking about default. We're not talking about Egypt's ability to service the debt. That is still a chronic issue in Egypt, of course, but at least for a couple of years, we have a breather.
How is that expected to reflect on doing business in Egypt?
It's very positively. I think from a business perspective, at least you can price now. Before Ras El-Hikma project, the dollar overshoot was making it very difficult for all the business institutions to price any products or services. And this actually contributed significantly to the inflation that we have seen, especially in February 2024, a record inflation. Some of it because of the supply side constraints, yes, but most of it was mainly driven by inability to price. At least now, businesses can price, so it's very important. Whether 45 or 50, we're talking about margins going down from 10 to 9, but not from 10 to minus 10. And again, I'm talking from a funding perspective and from a currency risk perspective in the short term. In the long term, it's different stories, like the outlook of any emerging market, what you are doing to grab or to attract more investments, what you are doing going to fix your chronic, sticky balance of payment issues. Are you trading enough with the world? I think Egyptian yields will go down in the short term, but if you're talking about a longer term view, I think this will depend on the real economy on the ground, not on the financial side, which is just... everybody's saying the financial market is always mirroring the real economy on the ground. But in the case of Egypt, even the financial sector, the equity markets in general started not to be a very good representation of the real economy on the ground, because not all the sectors are represented in the Egyptian equity market right now. And on the debt market, I think yields should go down, but the future will depend on Egypt's ability to, one, attract enough investments, and two, convince the business community and the investors, whether direct investors or indirect investors, that the chronic issues are being addressed.
How can Egypt send assurances to investors that the economy is on the right track?
There are three main challenges. We have been doing these reforms for so long. I mean, Egypt is not new to this kind of financial side reform that I always call it the financial side of the reform, because we start by, we're very late in the financial adjustment, and then we devalue or depreciate our currency. We sign with the IMF, we bring in some money, a fresh bunch of liquidity. It gives us some breathe, and then we always stop where the real economy needs, when it comes to the productivity gains, when it comes to localization of technology, when it comes to even trade and competitiveness. The last thing we need right now is the carry traders, those who invest in that. It's good to have, but you can't build an economic model on people who invest in the treasuries, because this is very volatile. What we really want is to see FDIs and even indirect portfolio inflows in the equity market and in the debt market in a more sustainable way. Egypt needs to convince the global investment institutions that it has a functioning model, because again, the economic identity of Egypt needs to be understood by Egyptians and non-Egyptians. We need to understand it as Egyptians first before trying to convince foreigners.
What do you mean when you say Egypt needs to define its economic identity?
So are we a state capitalist or we are pro-market? If we are state capitalists, fine, but we'll have to have the tools to do this. Otherwise, we'll keep adding and building debt to the extent that will bring us to the same position that we were at a couple of months ago. If we want to be pro-market, we should be pro-market. By the way, just to prove that it's post-ideology, the markets and, our job is to speak to institutional investors almost every day. Everyone who's investing in the Middle East is a client of EFG Hermes. So I can safely claim that it's not about the ideology, it's not about the spending on social programs, it's about the sustainability of the model. This Takaful and Karama program, for example, just to give you an example, was very, very well perceived by all the investment institutions, because it's something that will help Egypt sustain the plan.
Since you mentioned the institutional investors, what's the sentiment among them with regard to Egypt now?
Most of the institutional investors are in a wait-and-see mode when it comes to how Egypt will turn the Ras El-Hikma or the post-Ras El-Hikma project into a fully functioning economic model.
In February, the IMF director said for the first time that Egypt should not rush in selling state assets. How did you read this shift in the IMF position with regard to Egypt's state asset monetization program?
This is a positive development. I don't see a reason why Egypt would sell public assets at a very cheap valuation. I mean, it's not in the interest of anyone. And if we have options now, and if we can sustain our finances for a couple of years, and if we can control the debt, at least put a ceiling on the debt, on the public debt, and doing this without, being forced to sell state assets at cheap valuations, this is the right thing to do. Why would we rush into this?
But the state asset monetization program has been closely tied to questions of privatization and the attraction of fresh FDIs.
Bringing in investments or attracting FDIs comes in many ways. It's not like IPOing state companies. It's not like selling part of or a stake in this company or that. It's about the environment. It's about the competitiveness. So you can attract FDIs by giving incentives for investors, and you can start to think of or trying to minimize the impact of the crowding out the private sector. And if there are opportunities and if there are expectations of a higher return on capital, investors will come automatically. You don't need to sell assets to bring in investors.
What's your forecast for inflation rates?
Well, inflation will decline for sure, at least due to the base effect. It has already peaked. I think the last reading was like 31% or so. We might see an additional hike in fuel prices in June. But towards the end of the year, I think we are talking about 22-23%. At least this is our in-house forecast. which is like 8-9% drop in the annual inflation rate. And early next year, the base effect will play out. So you'd see inflation much, much lower to the 15% or so.
How soon can the Central Bank of Egypt start reducing interest rates?
It's very much related to the real rate that we are going to, or we want to keep attracting carry traders, which is not the right thing to do in my point of view. I think if Egypt wants to run a 2% real rate, which would still be high, but high for in the Egyptian context, given what we are talking about from a competitiveness point of view and from return on capital point of view. If assuming 2-3% real rate, I think we will see a significant decline in drop in interest rates. Towards the end of the year, maybe 200 basis point is the safest assumption. Could be more. I hope it can be more. But I can safely assume, on the conservative side, 200 basis point in the last quarter of the year is very, very much expected. And a more significant cut in the first quarter or the first half of 2025. So I think 6-7% from today to next year, to mid next year, is very doable.
To what extent can the loosening of monetary policies impact the business environment in Egypt?
This is a secondary kind of factor. We keep talking about the cost of capital and everything, but the cost of capital is broader than just the treasury yield today. So of course, the lower treasury yield will mean lower return or lower risk-free in general. So the cost of capital will go down theoretically. But this is not the main obstacle. I think it hasn't been the interest rate. From a financial and investment perspective, I think even if we run a slightly higher real rate, but tackle the real issues on the ground and the crowding out and this kind of competitive anti-competitiveness thing that we're running right now, I think it will be very positive.
Let's move now to emerging markets. What lies ahead?
I think emerging markets this year was very well positioned for a positive performance on the financial market side and also on the economic side, on the real economic side when it comes to trade, when it comes to manufacturing, when it comes to exports. The fact that the easing cycle or the normalization of the interest rates in the US has been delayed a bit. It paused the rally that we have seen in the emerging markets a little bit. But in general, emerging markets ex-China should be in a much, much stronger position than last year. Of all the emerging markets, I think the GCC countries are providing a very unique model because you don't see the currency risk that you are exposed to in the other emerging markets.
What's your in-house forecast for oil prices?
Without geopolitics, without the short-term fluctuations or volatility, I think $75 to $80 a barrel is a range on a normalized level. 60 to 70 when it comes to a normal recession. I think this year we are going to see the higher end of the forecast. So I would say above 80 because of the geopolitical risk and because of the physical oil market being really tight. We've seen OPEC plus cutting. This is definitely an important factor, rebalancing the markets when it gets a bit loose. So with the sticky supply, the swing factor here on the demand side is emerging markets. So if emerging market growth surprised us positively, or at least grow higher than the average of the last 3 years, which is a possibility, if we discount the recession scenario, global recession scenario, So I think the physical market will be tight. The price will start to reflect a tighter market and a geopolitical risk in the Middle East. Both of them will mean that oil will trade at the higher end of the range, which means above $80 on average. Of course, you would see it 90, you can see it 100, but on average, the average price should be $80 to $85.
How is a drop in oil prices expected to impact growth in the GCC region?
I think it will be positive in the sense of the speed of the economic diversification plan, the execution on the ground will be faster. You know, the positive thing is on the diversification is that the financial side has been diversified as well. When it comes, so we're seeing Saudi Arabia, for example, going to the market, borrowing, doing more issuances on the sovereign and also on the private sector side. Oil at 75, 80 will actually be positive for the diversification. I don't think it will be negative because this will mean Saudi running 4% deficit, which is very manageable. The UAE, in terms of diversification away from oil, we've seen a lot of listings from the giants, oil producers. There is a direction that this diversification and this reliance on oil will have to go down to the acceptable level in order to protect the economy from the cyclicality. I mean, when you don't have much fiscal room to maneuver, you're forced to do the right things at the right time. And I think that's what they are doing right now.
Thank you so much, Ahmed, for your time and insight.
Thank you very much for having me. It's my pleasure and honor. Thank you very much.